Good morning and welcome to the SERINUS Energy PLC Q3 2023 results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. I would now like to hand you over to CEO Jeffrey Old. Good morning to you.
Good morning, thank you. Welcome everyone to the SERINUS Energy PLC financial results for the 9 months ended the 30th of September. My name is Jeffrey Old, I'm the CEO of the company. With me is Stuart Morrison, the COO, Vlad Rybov, the CFO, and Calvin Brackman, our Vice President of External Relations and Strategy. Production for the quarter averaged 641 barrels a day. That was 117 barrels a day for Romania and 524 barrels a day equivalent for Tunisia. Tunisian production has remained stable. We carried out a lifting in October of 56,600 barrels, and we got a price of just over $85 a barrel. The Schwesch field continues to increase production and exceed expectation. As investors will know, we've installed artificial lifting pumps in that field, and we've been very successful in having those pumps increase their life from initially when we put the pumps in, they were lasting about 8 months. We now have pumps that are exceeding 24 months. So that has a real effect on the economics of those pumps. Installation of artificial lift in Sabrija W1 was planned when we did the workover of W1. As people know, W1 ran into junk in the well. It was going to take us 85 days to mill through it. A sidetrack will be about 22 days. So economically, it was just preferable to go and get a clean portion of the hole by means of a sidetrack. The sidetrack design and the target of the sidetrack has been completed, and we've started tendering for the long lead items. One of the big determinants of when we'll do that sidetrack is rig availability. And we're out looking for rigs and availability right now. As people know, rigs, there's not a lot of rigs in Tunisia, so finding the proper rig does take some time. And so that will be the major determinant of when we do that sidetrack and when we're ultimately able to get a pump into the W1 well. Sabrija N2 well was a well that had never produced. It had a damaged completion in the hole when it was originally drilled. We went into that. The sidetrack was very effective, removed all the damaged completion. We perforated that well. The well is dewatering at a slow rate. We want to go in and acidize that well so that the dewatering is more effective, and the dewatering pulls the water out of the fractures and allows the oil to come out of the matrix. We're negotiating or we're discussing with our partner these stimulation techniques to enhance that dewatering so we can get to the oil. That is ongoing. In Romania, we've had an extension to the exploration phase of the Satu Mare concession. We completed that at the end of October, and that was granting another 4-year extension to the exploration phase. And in that, we'll do some seismic reprocessing and we'll acquire some more 2D seismic. That will help us identify where we go next for gas in the Satu Mare concession. In the Moftino field, we have a number of zones that are not completed. They're higher zones. When we originally drilled the producing wells that produce into the Moftino gas plant, those zones were bypassed to go for deeper and more bigger zones. And as we deplete those lower zones, we will move up the wells. We'll complete those zones, and we'll bring that gas into production. Those are light workovers and can be done fairly quickly. The timing of that depends really on our internally generated capital and how we do on the depletion of the deeper zones. We are still waiting for the Romanian courts to recognize the ICC award that awards the 40% of the operating interest that we've been operating for the last 6 years. And the Romanian courts are not the fastest courts in the world. The Canara-1 water injection well was originally drilled as an exploration well for gas. It found gas of non-commercial quantities. We turned that well into a water disposal well for the produced water that comes out of the other wells. So far, up until the end of the third quarter, we've saved about $600,000 in water disposal fees for that well, and the cost of that well has been paid back from the water disposal. I'll hand it over to Vlad so he can run through the financial numbers. Vlad, do you want to go through these?
Thank you, Jeffrey. Yes, I will. So the revenue for the 9 months ended 30 September 2023 reduced to 13.3 million from 48.1 million in the comparative period of the previous year, which is a result of dramatic changes in the commodity prices throughout the period. The gross profit for the 9 months of the 2023 was 1.8 million, and the EBITDA for the 9 months of the 2023 was 1.2 million. Reduced from 12.6 million, again, as a dramatic result, as a result of dramatic changes in the commodity prices in the period. And overall, the company reported a net loss of 4.6 million in the 9 months for the 9 months of 2023, which compares to 3.4 million income of the previous year. Capital expenditure of 5.3 million in the 9 months of 2023. Splits out into Tunisia, 4.8 million, which is all predominantly on the workovers, and Romania of 500,000, which was spent on the further extension of the Satu concession and the Canara-1 water injection pumps, and there is this emphasis in the Martino area. The company realized a net price of $76.84 per barrel of oil equivalent for the 9 months of 2023, which compares to $162.18 per barrel of oil equivalent in 2022. As we can see, that there is a dramatic change in the commodity prices throughout the 2023. And the realized oil price is $78.68 per barrel in Tunisia. Predominantly all of the oil is produced in Tunisia, and the realized natural gas price is just above $12 per MCF, which compares to $36.66 per MCF in the comparative period of the previous year. The netbacks reduced in line with the commodity prices and comprised $34.15 per barrel of oil equivalent in 2023, whereas it was the netback in the comparative period of 2022 was $120 per barrel of oil equivalent. Romanian operating netbacks are dramatically lower as a result of dramatic changes in the commodity prices throughout the period, and comprised $4.22 per barrel of oil equivalent in the 9 months of 2023, which compares to $195.73 per barrel of oil equivalent in 2022. Tunisian operating netbacks has been more stable, but again, they were heavily impacted by the lower commodity prices and oil and gas prices in the 2023, and comprised $40.68 per barrel of oil equivalent in 2023, which compares to $59.11 per barrel of oil equivalent in 2022. The company reported cash balances at the end of September 2023 of $1.5 million, which compares to nearly just below $5 million at the end of 2022. The cash balances as of 15th November 2023 was 3.5 million, which is a result of the lifting of oil, which the company completed in the middle of October 2023. This slide summarizes and gives a visual of the graphic visual of the revenue, gross profits, cost of sales, and net income. We touched on the revenue, and on the cost of sales. The cost of sales decreased to 11.5 million from 30 million in 2022 due to significantly lower direct taxes and royalties, which are predominantly coming from Romania and are linked to the realized prices in Romania. The company managed to optimize the OPEX and put significant controls around the operating expenses, which led to a reduction of those by 28% against 9 months of 2022, despite the highly inflationary environment which we all are experiencing in the 2023. The gross profit was 1.8 million, as we touched on the previous slide, and we can go to the next slide and look into the average production volumes. As Jeffrey said before, in Romania, we're experiencing the decrease in production due to the natural declines and the loss of one well. The Tunisian production has been very stable despite of the workover program, which was undertaken by the company in the 9 months of 2023. And the average realized price of $76.84 per barrel of oil equivalent pretty much reflects the lower Brent price and dramatically lower gas prices in Romania. Production expenses decreased from 8.2 million in 2022 to 5.9 million in 2023. And that's split in Tunisia and Romania, with Tunisia incurring 3.8 million of production expenses in the 9 months of 2023, and Romania incurring 2.1 million. Group production expense per barrel of oil equivalent was $34.14 per barrel of oil equivalent, and that's split in Tunisia and Romania, as shown on this slide. Operating netbacks again reflect the significantly lower gas prices and volumes in Romania versus comparative period, with an average realized price being $76.84 per barrel of oil equivalent. And we looked into the realized prices and the netbacks of the previous slide. The capital expenditure, as we touched on the first slide, was 5.3 million, which splits to Tunisia, 4.8 million, and 0.5 million in Romania. In Tunisia, we incurred the capex on Sabria W1 artificial lift program and Sabria N2 workover, and just above 1 million was the capitalized inventory purchases for the upcoming workovers in Tunisia. The group's funds from operations were at 1.2 million, whereas Tunisia is contributing just below 6 million, and Romania using funds of $700,000, and the corporate expenses at the corporate level comprised 4 million. Overall, the EBITDA was 1.2 million, which is a significant reduction from the previous year EBITDA of 12.6 million. And the key trigger here is the dramatic changes in the commodity prices in 2023.
Good, thanks, Vlad. I think to sum it up, we've had significant drops in commodity prices. In the face of that, we've managed to cut expenses. There's the per barrel numbers in Romania are obviously affected by the denominator as the production falls, and we work to reduce the costs of that operation. Environmental and safety, we continue to focus on the safety and the environmental aspects of our operation. We've had no lost time incidents in Tunisia of 2,854 days, and in Romania, 1,618 days. In Romania, that's no lost time incidents since the start of production, the start of the plants. We've installed solar panels in Moftino to further reduce the electricity consumption, and we've just completed our environmental modeling or monitoring for the 2 business units, which looks at all our fugitive emissions, looks at all our plants, and we report that in our annual report. We have those fugitive gas emissions audited by third parties, and you can find the results of those audited reports in our annual reports, and those will be forthcoming in our next annual report. So the company continues to generate stable cash flow. We have $3.5 million of cash in the bank at the 15th of November. The asset base provides opportunities both in Romania for finding and developing another Moftino-style field, We have the large oil asset in Tunisia that is subject to those workovers. Going forward, we hope to be able to get the N2 well dewatered and have that producing. We would like to get the acid stimulation job done, but that really does depend on the conversations with our partner. And the sidetrack design for W1 and the long lead items are being procured. And as I said, rig availability is going to be one of the key items to when we are able to get that done. That'll be in 2024. We're just trying to find a rig and figure out when exactly in 2024 we can plan that. In Romania, we've talked about the block-wide geological geophysical study. That's to enhance the knowledge for the next phase of an exploration program, moving beyond the Moftino area. Remember, the Moftino gas plant cost $7.8 million to build, another probably $6 or $7 million to drill the wells to it. And we've announced previously that we're closing in on $100 million of revenue out of that plant. So the shallow gas projects, they don't last that long, but they really do generate you great returns. The 2D seismic program that we're planning and that we committed to in the extension of the exploration period is designed to find the next Moftino gas field. So there's good exploration opportunities in Romania, and then there's excellent opportunities to work a big oil field and just produce that oil field better. We've shown we can do that in Schwesh, and we're working hard to try to do that in Sabria. Going through this very quickly, the workover invention, the only thing we haven't really talked about is the workovers on Moftino 1003 and 1007. We'd like to do those in the first half of 2024, but as I say, that's dependent on how the depletion on the lower zones go. What we don't want to do is open up those upper zones, which are higher pressure and higher flow, until we've got all the gas we can out of the lower zones. If you look back at all of our reserve reports, historical reserve reports, we've outproduced what the reserve engineers, independent third-party reserve engineers, anticipated out of Moftino. We'd like to continue to extract all the gas we can out of that before we move to higher zones and open those zones up for production. Long lead items for Wind 12 artificial lift. After we've completed the installation of artificial lift in the W1, we'd like to turn our attention to our best producing well, which is Wind 12 BIS. And we'd like to put a pump in that as well. And so the long lead items for that are being procured in 2024. And again, depending on how W1 goes, when we can get that sidetrack done, once we have some performance that we can show our partner from that sidetrack, we'll move on to the Wind 12 well. That concludes the presentation. I'll hand it back to our moderator.
Perfect, Jeffrey, Vlad, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jeffrey, Vlad, as you can see, we have received a number of questions throughout today's presentation. And Jeffrey, if I may hand back to you and kindly ask you to read out the questions, give responses where appropriate to do so, and I'll pick up from you at the end.
Thank you. The first question, how can we get a copy of the summary of the geological review you completed this year and the general structural figures? The short answer to that is you can't. We conducted a geological review over the Satu Mare concession. That is proprietary information where we used our proprietary seismic and our well results to tie together the other seismic we have on the block, and that is proprietary information to the company. So we don't circulate technically sensitive information like that, and we don't plan to. What we plan to do is take that information to allow us to drill new prospects in Satu Mare. The next question, our costs and CapEx seems to grow or shrink to match the revenues, but there's never anything left for shareholder returns. That is not entirely true. Our costs have consistently been compressed. We've done a very thorough job of managing our costs, Our CapEx does grow or shrink to match our operating cash flow, not our revenues. And that's simply because we take the operating cash flows that we generate and we reinvest them in the fields for growth. So we are attempting to grow the business. And quite simply, if we, I gave the example of the Moftino field. Finding another Moftino field is a very high return prospect. And so we take our capital and we invest that in either increasing production out of Tunisia, which we've very successfully done in Shuesh, or we look to expand our production, increase our production, and quite frankly, find another Moftino field in Romania. So this is a growth company. We reinvest and we run our business based on the capital that's available to us from operating cash flow. The next question, the share price remains stubbornly below the net asset value and has remained so for quite some time. Not only does it remain below the net asset value, the share price is essentially trading at cash. We have $3.5 million of cash at the middle of November. This is incredibly frustrating. We believe that the company generates consistent cash flow. When we do find a field in Romania, we get a big spike in production and cash flow, but those are short-lived fields. So we keep looking for the next one. So we find it very, very frustrating that independent third-party reserve engineers reports, which are on our website, show an asset value, a net present value, including abandonment, including the capital required to invest to get that value of in excess of $70 million. And yet our share price remains stubbornly low. What are we doing to overcome this? Well, we try to show everyone those simple numbers. And we try to show people the deeply discounted value of this company. This company has great assets and has performed well on those assets. And certainly we've had times when we haven't been successful. We drilled 2 exploration wells in Romania. Both of them found gas, but not commercial gas. That was very disappointing for the company. But it only takes one of those to produce commercial gas to make a big result for the company. Are we considering selling any concessions? We consider buying and selling all the time. It's a question of price. At the valuation that our shares are giving us right now, our assets are far more valuable generating cash flow for us than they are selling them. But of course, I've sort of come through my career with everything is for sale. It's just a question of price. So no, we're not actively out there trying to sell any of our concessions. We've looked at whether there's ways to enhance value, but so far the value is best generated by generating cash flow. Next question, compared to management's previously highly successful records in other companies and critically much better shareholder returns, how do your expectations for SERINUS compare to 1, those higher bars, and 2, original expectations for joining SERINUS? Well, I'll speak for me personally. We maintain those high bars. We expect to make returns that we've done in the past. We've taken steps to do that. How does that compare to original expectations? Well, when I originally joined the company had $60 million of debt and 300 barrels a day of production. It's been a long process and hasn't been entirely in our control, but we've managed to eliminate that debt. We've managed to develop the Moftino gas field from what was a cornfield when I joined to, that picture that's on the front of the presentation, a gas plant that produced close to $100 million of revenue. The expectation is to continue to take these quality assets and work the assets, generate cash out of them and grow the business. That continues to be our expectation. We mentioned the OEBS court case and that Romanian courts are pretty slow. What is the impact of that, if any?
There's no, and the further to the question, we're not waiting for any compensation of backdated revenue. No, it's simply a frustration. For 6 years, we have in our presentations and in all of our reporting have called it a deemed 100% interest in the Satu concession. In March, we received the final arbitration award, which awarded us 100% of the concession. So we no longer call it a deemed 100%, it is 100% ours. Romania is a signatory to what's called the 1958 New York Convention on the Recognition of Arbitration Awards, which basically means the state of Romania recognizes arbitration awards. This is just a procedural impact, a procedural effect of getting the courts to recognize in Romania an arbitration award. What practical effect does it have on us? It doesn't have any practical effect anymore after the arbitration award. But prior to that, we really couldn't look at bringing a partner in. We have 100% of this block. You know, philosophically, we're not a business that needs to have 100% of our blocks. We'd like to have partners. Without that arbitration award, we were not able to bring a partner in. So in the future, and this reverts to the previous question, would we bring a partner into the Satu Mare concession on acceptable terms? Absolutely. Partnerships mean that there's more brain power, that there's more people looking at things, and there's a spreading of the risk. As I said, we don't have to have 100% of this concession. We would like to have a partner. And really what the OEBS case did was prevent us the ability to have a partner. That's no longer the case. There's no back compensation. There's no outstanding revenue. We paid 100% to build the Moftino plant. We took 100% of the revenue. We paid 100% of the taxes, 100% of the insurance. So we have for 6 years acted de facto as a 100% operator, and now it's simply we've been given 100% through the arbitration. What are the company's plans to return shareholder value? Well, we have had a shareholder vote last AGM that prevents us from buying back our own shares. So effectively, we're left at a position where we will take our operating cash flow and grow the business, and we believe that the market should credit that when we do grow the business. The company went through production. When we were at the peak of production from Moftino, we were at 2,700 barrels a day for the period. And the market sold us down for that. So it's been a very, very difficult fight to get market recognition. Next question. Sorry, I've got to scroll here. There's a question: what did the company make of Extellus taking a 7.5% holding over the period of October, November 2023? I'm afraid you'd have to ask Extellus that. We're thrilled to see investors coming in. That's a great business, and they've taken a significant holding. But I really can't comment on what their motivations are, other than they see an undervalued company that's a good opportunity. Can you give us timeframes on getting rigs in Tunisia at all? Could it be a year, 2, 6 months? What is the time frame? This has always been a challenging one. We compete for a very, very limited number of rigs in the country. I would say 6 months to a year is the best guess. There are rigs that we do not believe are appropriate. And so it's an even limited, a smaller number of rigs. I would suspect we would have an idea, an outcome on the rigs by mid-year of where we would get that availability. But we've found in the past that the right rig makes a great deal of difference when you're in operations. We don't want the wrong rig. We don't want a rig that's going to break down in the middle of operations, etc. So It's really very important to get the right rig and do your checks and get that rig certified properly before operations start. How long do we expect dewatering an N2 well to take? Well, at the current rates, a long time. We very much feel that acidizing that, which is a very standard procedure, will accelerate that dewatering and accelerate it quite significantly. And so what we're doing here is there's fractures that run through this reservoir that are filled with water, and we know that from our other wells. And you need to drain that water out of the fractures so that the oil, which is held within the matrix structure of the rocks, can move into those fractures. So you have to draw enough water out to get the pressure difference to allow that oil to come out of the fractures in the rock. At the current rates, it's very, very hard to estimate how long will it take, but it's not in a time frame that we're comfortable with. If we acidize that and open up all the perforations that we put into it, we think it would be very much quicker. What are the overhead costs that we've reduced? We've reduced cost of offices all over the board. We've reduced the cost of our operations in the field. There's efficiencies in things like how we're ordering our propane for compression. Certainly one of the overhead costs we've reduced is water disposal. We talked about the Canard 1. Instead of trucking our water to someone else's water disposal well, we've converted one of our exploration wells to water disposal. So it's costs like that, but it's all over the business. Costs have been reduced across the business. And that is the last of the questions, so I will hand it back to our moderator.
That's great. Thank you for that, Jeffrey and Vlad. And I think you have addressed those questions you can from investors today. And of course, the company can review all questions submitted today, and we will publish those responses on Investor Meet Company platform. But before we direct investors to provide you with their feedback, which I know is particularly important to the company, Jeffrey, could I please ask you for a few closing comments?
Thank you. Thank you for joining us. The results are, we're a stable business generating cash flow, taking that cash flow to invest it. I think that the business, Tunisia, is certainly not going as quickly as we would like. It's a place that it takes, we would like to have moved right from finding the junk in the hole in W1 to a sidetrack right away. That's what we would prefer. But the country and the ability to get equipment and services in there just doesn't allow that sort of speed. So we press on. We remain confident in these assets. There's a great exploration opportunity in Romania, and we continue to have, sweating the asset in Tunisia. It's a great asset. There's lots of oil there. We've just got to get more out faster. Thank you.
Jeffrey, Vlad, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, we would like to thank you for attending today's presentation, and good morning to you all.